Hello and welcome to another video, and in this video what we're going to be doing is going through this presentation here. This is one that we did a couple of weeks back, and just want to talk you through really the top-down views on asset allocation in 2018. I will note first though that we're going to focus on topics 1 and 2, so macro strategy and risks and opportunities, and we'll do back to the principles in another video because I think that probably deserves its own sort of separate video. Anyway, just a brief bit about myself. Most of the regular viewers should be pretty familiar by now, but founder and head of research at Top-Down Charts, started the company in September 2016. Previously worked in investment strategy on the buy side, managing money, mostly multi-asset pension, long only funds, and yeah, it's a Top-Down Charts is an independent research firm. Clients are hedge funds, pension companies, wealth managers, investment consultants. And the reason for being for the company is to add analytical muscle to active asset allocators. That's really sort of the mission statement, I guess, if you could call it one. And that means, giving portfolio managers investment ideas, risk management input, macro insights. And if you think about top-down charts, what we are is very much top-down, macro-focused, data-driven, chart-focused, and very comfortable using technicals as well as fundamentals, and the view is that the charts are greater than opinion. And we're based in Queenstown, New Zealand. So into it. So the first one here is looking at what I think are really two key charts for this year, and really shows the story of business cycle maturing in the developed economies. And if you look at the chart on the left here, what it is it's the composite economic sentiment scores across the major developed economies, so USA, Eurozone, Japan. These are Z scores, so for example for America it's taking just about every different survey that we can get, such as the NFIB, consumer confidence, PMIs, taking the Z-score of them and combining it to give you a sort of broad view of how various participants in the economy are seeing economic activity or how they're seeing the outlook. And what I find very interesting about this chart is that it's not just America which saw this big turnaround or this big spike. The whole sort of Trump hype, but it's actually was reflected across developed economies. So you've actually had this synchronized upturn across America, Eurozone, and Japan. And of course they're all going at different levels, but I think that just the core signal moving in a similar fashion is something that really stands out to me. And it lines up with chart number 2 here, which shows a couple of measures of capacity utilization for the developed economies. So you can see there that from 2009 to really 2015, 2016, there's this prolonged and deep period of spare capacity. And it's really only in the last 12 to 18 months where, well, really only for the last 12 months, 6 months for even industrial capacity, where things have actually gone back to normal. And pretty much the headline says it all, spare capacity is running out for developed economies. They're now fully, pretty much at full capacity. And you line up these two kind of charts, and the logical conclusion is that the next step equals inflation. And then I've got here the bullet number 2. The next step is monetary policy. Global monetary policy tides are beginning to turn. So we've got the 2 bullet points here. That for developed economies, in aggregate, so if we look at that chart in aggregate, that 45 bips is now 46 basis points, with the Bank of Canada hiking 25 basis points. So yeah, in aggregate, developed economies are already in hiking mode on a headline basis. Now, if you look at that shadowy darker line below, that's the shadow composite or QE effective rate. So that's substituting in the shadow rate, which is calculated by the RBNZ, and that's basically the headline policy rate adjusted for the impact of quantitative easing. substituted in for Bank of Japan, Bank of England, ECB, and the Fed. And you can see there that not only, in this period here in 2016, or 2015 to 2016, where there was this effectively over 150 basis points of easing imputed through the stepped up quantitative easing by Bank of Japan and ECB. So it's and it's not a coincidence that that was when we saw growth really start to turn around. We saw that big sort of dual corrections at the end of 2015, early 2016, and that was certainly helpful. And then since then, we've actually had over 100 basis points of tightening, and I think that really is just the beginning. And if you go back to these two charts, solid synchronized strength across developed economies and spare capacity, well, no spare capacity, that reinforces a return of inflation. And when you have inflation coming back, it's no longer reasonable to run such extremely easy monetary policy, and we've already seen the banks starting to talk about that, and we're actually seeing it in action. And so this is going to be, I think, a key theme for this year. As to whether it, makes its fullest impact known this year, that's an open question. I mean, if you think about how monetary policy moves, it's a very slow-moving beast, and the impact of it is equally slow-moving. So, it could be quite a while before that actually starts to impact. But then again, the moment the market gets wind that, we're no longer in this easy forever, massive easing kind of regime, then that could drive a bit of repricing of risk. And then if you look at the chart on the right there, so this is rolling net hikes and cuts, rolling 12-month sum for emerging markets in the black line, developed in the blue. And this is just to highlight that, while emerging markets have been in this big second easing cycle, they're pretty much at the end of that now. And so they're going to be joining in the fun games of this theme of the monetary policy tides turning. Speaking of emerging markets, we've got here two really key charts, I think, for emerging markets on the macro front. First one on the left here shows a composite risk pricing indicator, which has been sort of inverted so that, when you get episodes of panic, it's dropping all the way down. And when you get periods of, very calm or complacent, then it's pretty much at where it is now. And if you look there at the black line, that is the OECD Composite Leading Economic Indicator. That's the aggregated view for emerging markets. And you can see there that there's this tendency for it to undergo sort of what you could call virtuous cycles, where calmer risk pricing makes it easier for growth, and better growth makes for more fertile ground for risk pricing to be more relaxed, because it's more in times of economic stress that can trigger off financial stress, and financial stress can equally trigger off economic stress. And with these kind of charts, the time of most risk is not when risk pricing is in the panic mode. It's when it's in the opposite of panic mode. Oftentimes when it's in panic mode, that actually marks a climax. So I think the fact that this virtuous cycle is underway here is one important fact to note, because this could well continue. The whole implication of a virtuous cycle is that it can be self-reinforcing and last for longer than you might necessarily suspect. But at the same time, I guess the glass half empty view is that the cycle's already rebounded quite a lot, and that it's basically at complacent levels here. The companion chart there is China's stimulus indicators. So this is a view of monetary conditions and the fiscal impulse. And in 2015-16 there was this really big stimulus push to turn things around there, and that's because 2015 and even 16 there's a bunch of cyclical and structural headwinds in China, and those had pushed growth to lowest levels in well, a long time, over a decade I think it was. And anyway, the bottom line is when you get structural cyclical forces acting as a slowing influence, then and you're a very much managed economy, and you've got very proactive counter-cyclical macroeconomic policy, then of course this is what you do. You step up monetary easing and fiscal policy initiatives as well, and they did that pretty much in coordination there, and that was a key to turning that situation around, and it was also very good for emerging markets and for commodities. Rather than just reminiscing on history, the point of mentioning these is that if they were the ones to benefit from it, then they would be the ones at risk if that were to roll completely over. So I think that this going from massive tailwind to now less of a tailwind, at least, it's probably within the realms of reason at the moment before it necessarily gets to a point. I think it would have to go I would say that it would need to go down towards the 1 standard deviation below for you to start getting very actively bearish on that. I guess the other aspect there is that there is a lag to implementation, or the lag to ultimate effects that you see out of that. But the fact that it is rolling over does tend to cast some doubt on the chart on the left. And so that one's going to be one that we'll be watching very closely this year. So this is a quick summary on that. We've got a maturing business cycles. Global growth is looking the best it's been in years. Emerging markets are looking much better. We're pretty much as close to synchronized global growth as it gets. Progressively tighter capacity, and that means inflation is to come. Monetary policy tides are turning, so these are two of the big themes I reckon for this year. Developed markets are already turning the corner on monetary policy. QE, quantitative easing, is still in force in the Eurozone and Japan, but the best days of quantitative easing are behind us for this cycle, and the reason why I say this cycle is because we will see quantitative easing again in the future. But I think it's fair to say that we're in wind down mode at the moment, and actively so for America. Emerging markets getting close to the end of their easing cycle as well. In terms of the investment implications of that, which we always have to come back to, more inflation, which means higher nominal growth, is positive for earnings. Commodity bullish at the margin, and bearish bonds. Those are the high level impacts. Less monetary policy support, as I mentioned. Life becomes more risky at the margin in growth assets, and progressively so. Speaking of risk assets, let's move into the risks and opportunities section. So we're going to start here with two quite interesting charts, really. So the one on the left is US high yield credit spreads, and you've got them at pretty extremely low levels. And also want to direct your attention to the red line on the chart on the right, which is cyclicals versus defensives relative performance. And both of those are at extremes, and both of them appear to be supported by the economic cycle indicators. So if you think about that, you've got sort of uncomfortable levels on a couple of assets, or a couple of indicators here, credit spreads being one. And if you think about the level of credit spreads being sort of a valuation indicator of such, then when you get the lower you get, the more overvalued it is. But as I've mentioned elsewhere before that valuation alone is not, the best timing tool. It's not the best tool in general for sort of short to medium term active decisions, because if you look back in the mid 2000s, you get to 2003, 2004, and you're already thinking, US high yield credit spreads, they're very overvalued at that point. So, you take an underweight position or you even go short. You're sitting there for 3, 4 years just getting steamrolled as nothing happens to spreads. Before, you know, the things eventually came home to roost. So the reason I point that out is that, that there needs to be a more holistic view than just valuations. And this economic cycle indicator is just one of the sort of risk indicators that I am keeping an eye on. And really what you'd want to see on this to become more sort of tactically bearish or more aggressively bearish is that the economics start to turn. And at the moment, you're seeing nothing of the sort. It's actually getting better. I mean, if anything, you could potentially argue for lower spreads at this point. And likewise, the cyclicals versus defensives, you can say that this very stark, very rapid and big move in cyclicals versus defensives has been entirely justified by the improvement in the PMI. I mean, this one will turn, it will roll over at some point, and when and if that does happen, it would probably be driven by a deterioration in the cycle aspect. So, it's a waiting game on that, but I would say that both of those where they are represent risk in that they're at extremes. One rule of thumb that I've learned over the years in markets is that extremes don't last. They can last for a while, but it's identifying these extremes and identifying the catalysts or the key indicators to watch for to sort of get the next step. And looking at that, those cycle indicators is going to be key, especially thinking about that in the broader context of tightening monetary policy in a maturing cycle. Now, tying this one again back to the macro view, you see a turn in nominal GDP growth, longer term growth, and I think it's fair to say that, just on maths alone, let alone some of the sort of shorter term trends that we're seeing in play at the moment, it's fair to say that US, longer term measure of US GDP growth is on the rebound. Those are IMF forecasts there, but I'd say that's probably about right in terms of where my thinking's at. And when you see longer term growth metrics turning like that, and you think about US bond yields, then that's one reason to sort of be thinking that over a medium term that the bias there is to expect higher yields. We'll see a lot of chopping and trading around that, as we usually do. On a shorter term timing basis, we've already seen US bond yields are on the move, and I think the indicators are pretty consistent with that. Starting to see build up of short positions in the futures, so there is a possibility that we do get a bit of a short-term short squeeze or slight pullback in yields on the way up. And that's just identifying sort of the tides, which is this, the tides are going out now, versus the waves, which is, these little waves in between. But at the moment, I'd say that the tide is going out for bond yields, and equally so for quantitative easing. The monetary policy tides are going out, and what that's doing to the shadow Fed funds rate is that's causing it to rise. And we've had this relationship here where gold has tended to trade fairly closely to that for pretty good reason. It's kind of similar to a similar level and concept to real yields, and gold tends to trade inversely to real yields for good reason, because holding gold, the opportunity cost is that you're not getting paid any interest. And if you look at then where the current level of the gold price is versus that shadow Fed funds rate, then you look at gold and say, well, yeah, there's this whole geopolitical aspect and all the other arguments that they usually roll out, but when I look at this chart, I say the risks to gold are to the downside. Certainly, though, I guess one thing to think about there is that it kind of reinforces the view that gold will be, potentially acting as a decent hedging asset in the next downturn, because the next downturn will probably get more quantitative easing, and if you get more quantitative easing, then that's probably going to be good for gold. Now, moving on to the next one. These are two very interrelated charts here. So we've got the breadth of valuations across global equity markets, and in the light red line, that's the percentage of countries with their forward PE ratio, the Z-score of that, is at least half a standard deviation greater than average. And that's sitting just over 40% at the moment. So quite a lot of countries are starting to become expensive. And, in terms of a more rigid example of what would be expensive is, anything that's trading at least one standard deviation above its long-term average. And in that respect, it's 20%, or sort of 1 out of 5. And, if you compare this to previous market cycles, it's just nothing compared to what we saw in the late 90s, even that period in the early 90s. But it is at similar levels that we saw towards the end of the 2007 run, and also just before, that peak, before that little bear market back in 2015. So, I guess the higher this goes, the more difficult things become. The more difficult it becomes to find relative value, the more difficult it becomes in absolute terms, because, as I said before, you need to look further than just valuations alone, because, in the end, if you look at that 2007 period, yeah, things were mildly overvalued. Well, certainly there was pockets of overvaluation, which even in itself, if there's pockets of overvaluation, that's something to pay attention to, because it could be reflecting some vulnerabilities. But in the end, what it was that rolled their market over then was a collapse of the housing market. And then, of course, we all know what happened as a result of that housing market collapse. So, that's why I place quite an emphasis on looking, studying quite closely what's going on the economic front, because that's really a key driver for how to actually deal with higher valuations. And then the accompanying chart to that is that with higher valuations, we've also got lower volatility, but I think that that's going to be on the turn, because, as you get more and more monetary policy tightening, I hesitate to say tightening because it's more about stimulus removal, and, that is kind of semantics, because stimulus removal is tightening, but, even just moving away from extremely easy to just slightly easy is, I think, going to be one thing that's going to lead to a turning around of that, and, possibly return to the more extreme bull market type of volatility that we saw in the late 90s, or if not, heading into a period where it eventually goes very rapidly in the other direction. And I think you probably gathered by now that I think, my three themes for this year, if you wanted to pick out the biggest or most important or most wide-reaching ones, it's, as we talked about in the macro strategy section, it's maturing business cycle, particularly in developed economies. It's a turning of the tides of monetary policy, And then the third one, in terms of bringing these themes back to an asset allocation front or an investing front, is the interaction of those two themes with this increasing overvaluation across markets, as we saw there in the chart on that global equity valuation brief chart, but also across asset classes. So this is quite a cool chart here. I was quite happy when I put this one together. Shows you US assets. So you got treasuries, the S&P 500, and property, and these are just valuation metrics relevant to those, and they're standardized. So we've got Z scores there. And what's very interesting about this is that just about all three of these are pretty much at or close to one standard deviation above average. So they're in the expensive zone. Nothing, they're not like as extreme as equity valuations got in the dot-com boom, and they're not as extreme as property got, in the mid 2000s credit boom. But they're getting up there. And it's quite an interesting chart too to look at on the flip side, where you get these periods where things become very cheap. The equity market became cheap, and then the property market became very cheap as well. And so this some people call this the bubble in everything. It's possibly a little bit too sensationalist to say that, but we are seeing more and more assets becoming expensive, and when you start to remove the monetary stimulus that kind of helped get to there, and you start to have inflation come in, then that's going to make things more difficult there. And the second chart here, you've got the cash allocations. I think these two charts are really beautiful to look at side by side. You've got treasuries expensive, equities expensive, property expensive, and everybody is pretty much at their lowest level of cash in a long time. So we've got the ICI funds. This is implied allocation, so money market funds as a percentage of all mutual funds. So it's kind of try to tell you where things are at just based on mutual funds alone. And then the black line there, it's the AAII, American Association of Individual Investors. They do a survey, and that's the reported cash allocations that people have got, those respondents have got. Yeah, and so it's at around 15%, and just over 15%. So it's not zero, but if you look at in the scheme of things where it's been in the past, people are obviously invested. I mean, that's how you get higher asset prices, is that people get fully invested. And so the contrarian looks at these two charts and they say, okay, treasury is overvalued, stocks overvalued, property overvalued, cash undervalued. And certainly the contrarian would know what to do in this situation. So just to sum up, risk pricing is complacent. We saw across emerging market risk pricing, credit spreads, and the VIX. It's complacent but justified for now, and that for now element means that we need to be paying very close attention to the lead indicators, to the coincident indicators. Certainly I think that you need to be increasingly sensitive to signals at this point. Wary of noise, very wary of noise, but increasingly sensitive to a turn in the signals on that front. Bond yields have likely bottomed out, as we saw with that good chart on the longer term view of nominal growth and bond yields. And the quantitative easing tides are going out, but still going to be taken one step at a time. We're seeing more overvaluation across assets and markets, and as I said there, when overvaluation meets a maturing cycle and monetary policy tightening, life becomes harder. This party can continue for some time. It could go on for another couple of years even, but it just highlights the point that I said before. At this point of the cycle, when you need to become increasingly vigilant, and for an active asset allocator, which we'll talk about those principles on another episode, but one of the points that I make in that is that the job of an active asset allocator is to get those big movements right, those getting the shorter term movements right, and finessing across within the growth or defensive mix. That can be good, but the biggest thing is getting the growth versus defensive mix, so cash and bonds versus stocks right. And we are nearing the end of what has been quite a long cycle, and it's the people who are on top of that are going to be the ones that come out on top. And then the final point there, cash allocations are at the lowest point. And from a relative value standpoint, cash may be one form of relative value. And the other thing I mentioned there too is that as valuations move higher, relative value becomes more important, both as a defensive means and both as a means of identifying opportunities. And so look, I'll wrap it up at that point.